3 months is not a time frame to be an investor, right? You could speculate. I mean, I think there are people out there, if you think that, like some of my clients, that Trump is playing 3D chess and everybody else is playing checkers, then, maybe you speculate. We wouldn't recommend that. Look, if I've got a 5-year time horizon, I want to be in equities. We like U.S. equities. We want to be diversified. We think that value stocks are probably a better value, non-U.S. equities, as we talked before. But if someone's got a need for money in the next 90 days, 6 months, 12 months, even 24 months, I wouldn't have that money in the market anyway.
Hi everyone, I'm Joe Duran and welcome to Rise Up, our weekly review of the markets and all the big stories and a conversation with some of the most brilliant minds in the investment industry and in the planning industry to talk about not just what you should be doing with your money, but how you should think about your financial plan as well. Unfortunately, today Terry is not with me, so you're stuck with a CFA and no CFP on this side of the house, but we do have two brilliant people. One of them is a CFP. So Scott, it's great to see you and welcome.
Thanks.
Scott, as many of you know, is a partner and senior leader at Bleakley, a $12 billion now firm in assets, thousands of clients that they look after every day, taking care of their financial lives. And we also have Alexis Miller, who is the director of research there. Alexis, welcome. It's great to have you on. And you're going to be talking about the investment side of the house. And obviously, it's been a really fantastic week. As you know, on this show, we really like to keep it conversational. We also love your feedback and your questions. So we're going along. Please feel free to welcome. We do have today open questions from folks, which we're really excited to talk about. Obviously, the big story this week, far and away, was the incredible market ebullience that we've seen. It's been fantastic, Scott. And everyone's, the last few weeks we've been talking about hold on to your hats and concerns about going down, but we're seeing some really strong markets here. We've recovered. I think we're a bull market territory once again on the NASDAQ, although we are still negative for the year. And the S&P 500 has now ticked positive, as has the Dow for the year. Obviously, we're still down from the peaks, which were reached early in the year. But the NASDAQ, again, is up over 20% from its lows, although still below the end of year last year and well below the peaks that we had. But obviously, we're seeing that happen. We're seeing the Mag 7 go up, and we've seen Bitcoin resurgence back over 100,000. So lots of things happening, all triggered in large part. I think we were in a reasonably good, stable place, and then we had a lot of progress, it appears, on the tariff front. And I think the biggest igniter to this market was the 90-day pause that we saw in China. So I guess first let's talk about what this all means, Scott, and how people should be thinking about what's happening right now. We're going to do a deep drill on the tariffs. We have some great questions on what it means. But Scott, I'd love your thoughts on what's been happening with the markets in general this week. And obviously, we're following now several weeks of momentum of new highs from the recovery, week after week, and positive week after week after week. So how are you feeling about things?
Generally speaking, we're feeling pretty good. Everybody feels better when the market recovers. We had talked about this a little bit offline. Look, it's going to be a process, right? This is a 90-day pause. I think there's a lot of people out there who are hopeful. The market seems to be hopeful that cooler heads will prevail, that they'll negotiate some kind of a reasonable deal around all these tariffs so they won't be that damaging. I think we'll probably get to a point, though, where maybe there will be some pushback from one side or the other. The market might have a negative reaction. So I think people should be patient looking at the market. I think that people should be mindful of their liquidity. There might be an opportunity here if things do go sideways for the market to drop. And it might get sloppy as we get into the late spring, early summer. So I think if people do have a liquidity need, they should be mindful. I don't think this is the time to go all in, but I do think that things seem to be lining up better than I think a lot of people feared, 30 days ago. So yeah, we're relatively optimistic.
And Alexis, this is a big part of what you do every day. Obviously, valuations, we have more uncertainty about earnings, although the earnings reports have been pretty good. But a little optimism here. But valuations still quite frothy, obviously a lot higher than they were just a month ago. So how are you feeling about things from an investment perspective?
Yeah, I think that's exactly right, Joe. And, Q1 earnings, to your point, were stronger maybe than feared. But I think I agree completely with what Scott had said. We're still in this transition period, and what ultimately happens in the next 90 days will determine the path forward. But I think something we're reminding ourselves is, even though Q1 earnings were good and maybe there was some pull forward and inventory stockpiling that helped sort of mask what is going on, that there is still disruption, that is happening every single day and that has occurred with all of the uncertainty this year. And that might, come through and be more evident in Q2 and Q3 earnings, which we think, again, could be a driver for things to reverse themselves, just given all of the very quick exuberance that we've experienced in the last week on the heels of the China news.
So, Scott, the inflation news has actually been quite good, and even the economic news has been quite good. We had a couple of shaky numbers, maybe 3 weeks ago, 4 weeks ago, but things seem to look pretty good. When you look out, I know you have been thinking and talking a lot about being diversified, being in different asset classes. I believe the international markets are still far outperforming the U.S. so far year to date. How do you think about that, U.S. versus international, in this context when the U.S. seems to be recovering? Is international participating? How should you think about it as a financial planner?
Yeah, we still feel like non-U.S. equities are still very cheap relative to U.S. equities, even as much as the market has come down. So we're still going to maintain, in our practice, we're still going to maintain a good non-U.S. equity position, 25-ish maybe percent. We still like America long term as a market, but there's so many large, multinational companies out there that are domiciled, someplace else, whether it be Europe or Asia. And because of the fact that they're non-U.S. equities in the last 10 years, they've been cheap. They've been unfairly, I think, priced, if you will, not loved. So again, yeah, we like going forward non-U.S. equities, and we think value stocks are still fairly attractive. But yeah, we're still going to maintain our diversified portfolios going forward. We think the strength of the portfolios going forward, between now and the end of the year, we think we're going to get more return from our non-U.S. equities, from our value equities. Our healthcare managers pretty optimistic, even with all the negative news we've seen in healthcare in the last few weeks. So yeah, we think being diversified going forward is still going to make a lot of sense.
So, Alexis, a lot of the folks watching own assets like bonds, and obviously interest rates have been kind of interesting here. We still are pretty high relative to what you would expect. So, and I noticed actually that the spread for lower quality debt has narrowed. So, a lot of the risk that had been put back into lower quality debt has actually narrowed. So, talk a little bit about the debt markets. If you own bonds, should you be in the high quality U.S. Treasury? Should you be more in the junk bonds or high yield bonds, as they call them more politely? Any thoughts on the bond market?
Yeah, to your point, rates still are elevated, and all of the commentary that we've really heard out of the Fed is more dovish, and they seem to be in no rush to cut rates. And again, to your point, the 10-year remains pretty elevated in that 3 to 4 range. And that's also something to think about from an equity perspective where, it does have an act as a headwind to valuations, especially as you approach, closer to 4.5% on the 10-year. So generally speaking, in our fixed income sort of investments, we are still, staying lower duration.
And lower duration means obviously shorter term, like not out 3, 4, maybe 10 years, maybe 3, 4, 5 years.
Exactly. And also sticking with higher quality because, you're not really getting compensated for going further out in terms of duration and extending that, or, going further down sort of the quality stack.
Yeah, again, 6 weeks ago, I think there was about 150 basis points. So if you had a lower quality bond, you were getting 6%. Now you're back down to very small spreads with junk or high yield and U.S. Treasury. So you're taking a lot more risk. Obviously, if the economy goes sideways, those are going to spread again, and the value of your bonds go down a lot. When you're looking at bonds and building a portfolio, Scott, I'd love your thoughts. Tell me a little bit about how your clients think about this sort of question. Like, okay, if I've got 50% in stocks and 50% in bonds, what do you like to do with those bonds? Is it laddered munis? Is it high yield, so you get a little bit of a premium return, if a higher income yield. Obviously, at 4.4, that makes a financial plan much easier to do than when we had 0% interest. But the spread is almost the same as when we had 0% interest. So, how do you think about bonds when people are contemplating what to do with their non-risk assets? Because I think most people think of bonds as a lower risk investment that they're looking to generate yield rather than get capital appreciation.
Yeah, I look at that a couple of ways. One is, given all the uncertainty out there right now, and you'd mentioned this before, and Alexa sort of kind of agreed, I guess, that why take the risk now? So certainly right now we're not going to want to go down on the credit spectrum. So we are very intentionally in high quality, relatively short duration bonds. How we look at our bond portfolios for our clients, we're very intentional about that. So we've got clients where they're going to be retiring in the next few years, or maybe they're already in retirement. We use bonds as income. So we'll ladder a bond portfolio. If I've got a client who needs a few $100,000 a year of income, we'll look at laddering bonds so that they'll mature as we need that money, right, to cover their annual expenses for retirement, along with the yield that the portfolio throws off. So, our bond portfolios are there to provide liquidity down the road. Using ladder bonds is a great way to know exactly what you're going to get and when you're going to get it. So, yeah, we're very careful there. We love to use taxable bonds where we can in an IRA account, right, or a pension account where we can get that higher yield in a tax-free environment. If we don't have access to that and the spread works, given our clients' tax brackets, then we'll use munis. But yeah, most of our bonds are high quality, laddered bonds. And then we are probably about 10% of our bond portfolios, we're getting involved in private credit. We're very, very picky about
private credit basically means bonds that are not public.
That's
and
right.
So they're less liquid, but you get a high yield on them.
That's right.
Yeah.
And you've got to be very careful and very thoughtful about who you work with in the private credit space.
They're typically, you don't buy these directly, right? You have a professional manager
That's right.
who's coming in size,
That's right.
negotiating secured position, senior in the debt stack.
That's right.
Words, yeah.
That's right. And that's a way for clients who don't need the liquidity. So if we're talking about just looking for yield to enhance that income for our clients, particularly our retired clients, it gives us an opportunity to maybe pick up a 9% yield, where the 10 years yielding somewhere around 4.5. So we'll mix a little bit of private credit in there with that as well.
Great. Well, the second story obviously is all about the Mag 7. We get a lot of questions about them, and they've had a heck of a week, led predominantly with NVIDIA. Obviously, they had their big, I can't remember exactly how many thousands and thousands of chips that they're selling to Saudi Arabia, I believe. So, Alexis, I think Tesla's still down quite a lot from its peak. I think we hit around $600 post-election, still around 330 or something like that. But nice recoveries in Amazon and Alphabet, up 8 and 11% respectively. How do you feel about the Mag 7? Is that trade still a thing, do you think? Or do you think we need to reimagine the Mag 7? Because there seems to be quite a dispersion now amongst the performance of these.
Yeah, absolutely. So we did see, the Mag 7 ETF cross above the 200-day moving average, which is, if you look at technicals, it's a very bullish, positive sign that they're moving back in that direction. And obviously, some of the trade talks have removed overhangs, and risk is back on in the markets. And these stocks typically do well in those sorts of environments. But I would also, remind everyone, and we're reminding ourselves that we entered this year, and this group was extremely overvalued. Very expensive from a historical perspective in every which way that you looked at it. And I think the main question on whether or not, forward growth can actually justify and support the valuations on a go forward basis really still remains the question. So while these companies are important and they're not going anywhere, and fundamentally, everything is still intact, I think the valuation still remains the main question, especially if we do see some sort of slowdown later in the year when it comes to earnings and earnings revisions.
And a lot of it's about visibility, right? Like when you look at a company like Microsoft, that seems to be the grown up in the room. You know that it's fairly predictable. It's not going anywhere. And maybe Tesla's the petulant, more noisy, because a lot of it is on the hope of what happens with robots and what happens with self-driving, all of which is really going to have to offset what's happening with their actual earnings, which are the cars that are not doing as well as they have been for quite a while. Let's not get into the politics of it, but they have different risk profiles, right?
Yep, exactly. And I think, now that they're back up 30%, everyone is wondering, oh, should I be buying now? But I think the opportunities to buy are, when and where NVIDIA was trading a month ago, rather than chasing it when it's already, had a significant move off the
Scott, I
lows.
am sure you get this call all the time. Hey, I need to get back in now because it's gone up. Or somebody calls you who you've never worked with before. It's like, I got to own the Mag 7. How do you think about like chasing? Obviously, this market's you're always in a battle between the fear of missing out and the fear of losing money. We're right now in the fear of missing out phase, it feels to me. So, how do you regulate that on people who are like, okay, I got to get back in. I missed the last one and I got to be in the Mag 7?
Well, thankfully, we don't have those conversations, Joe, in our office because we've got a plan and we're pretty disciplined. So, to give you an idea, what we've done here, we've always had our position. We've also diversified around those positions, right? So, we've liked value, non-U.S. and healthcare. So, when the market, the broader S&P was down, I don't know, 7, 8, 10%. Earlier, not too long ago, actually, just weeks ago, our portfolios were flattish because those other assets, were very good counterbalances. We did rebalance portfolios once or twice in the middle of all that. So when the market was down, we added equities. So we did get some of that exposure.
Let
But
me
again,
just double click on that for a second.
sure.
Probably the most powerful thing if you have a financial plan is to not make any bold moves and just simply rebalance to your target allocation, right? Like if your stocks go down a lot and your bonds stay stable, you now have more in bonds than you originally wanted. So it's simply rebalancing. You'll be rebalancing almost always into down markets, putting more stocks and selling out of stocks and buying more bonds when they've had a big recovery. So the act of just being disciplined about staying close to your target allocation actually gets you to do the right thing, which is sell low, buy low and sell high, rather than the reverse, which is what we do emotionally.
That's right. And that's what we've done. We've had two rebalancing trades,
These are
firm
not
wide.
market calls. This is you saying, hey, we've got to reallocate because stocks went down 20%.
Stocks were down. You were supposed to be 60% equities, and now you're 58 or 57 and a half. We add that 2.5% back. We get some exposure to the Mag 7, of course, because they're a big part of the market. But we also got exposure to our non-U.S. equities, to our value stocks. And we've had a nice little recovery. And that's, the money we put in at that level has given us a little bit of lift. We recently took a little bit off as we got back to these highs. I have a feeling we're going to get a chance to do another rebalance here, probably sometime between now and the middle of the summer. And if it happens, we will. We always do it as tax efficiently, of course, as we can. But yeah, look, we have a plan. We work the plan. We're not, our clients were very, very calm through this whole process. We'd have conversations with clients, quite frankly, in the last few weeks where, we'd be talking about the portfolios being flat or down 1% or up 1%. I had people say to me, because they weren't really looking at their particular portfolios carefully, just watching the news and asking, well, how is that? I was actually on with an older client whose daughter sits in on the calls. And she said, when I said, yeah, the account's up 1% on the year. And she's like, well, how's your account up 1% for the year? My accounts are down like 5%. And then again, explaining, well, number one, we've been doing this for a while. We've got a plan. And, if you weren't in growth stocks and you had fixed income and you had value stocks and you had some non-U.S. equities and some gold like we do in our portfolios, we've actually done better. So, yeah, we want to just work the plan. The noisier it gets, the more we want to work our plan.
And Alexis, the market doesn't just go green, red. It's often in the middle yellow zone where you're not sure what to do. I would just one thing, and then we'll leave the Mag 7. People seem to forget that if you have the S&P 500, you have a big allocation to the Mag 7, right?
Yes.
Yep.
So if you then double down and buy more Mag 7, you're really overweight. And I think most people would argue the Mag 7 is already overly representative of the
Yeah.
S&P 500. Most of the performance last year was in fact from the Mag 7 and not from the rest of the market.
That's exactly right. Exactly right.
We have seen now from Bitcoin's behavior hitting 103,000 for the third time. It's broken 100,000. And a lot of people saying that's the last time we'll get in under 100,000. Interestingly enough, it was meant to be a diversification trade like gold. It didn't turn out to be that way. It went down to 85,000, 83,000, maybe even lower at one point for a day or two. And now we've recovered basically in line with the market. So, how are you feeling about crypto as an asset? And then, secondly, how do you think about it in a portfolio construction context? Because it doesn't appear to be like gold, which was hitting new highs when the
Mm-hmm.
market was, down 20%. So, how should you think about it as an asset class as a standalone first, and then second, as part of a general portfolio?
Yeah, no, that's a great point. And I agree with you where typically Bitcoin has been seen as this risk on asset and tightly correlated to the NASDAQ and tech stocks. And I think that is still true for the most part. But there was some interesting days and interesting points of time where, most indices were down, below their 200-day moving averages, which again is a technical signal. But Bitcoin actually stayed above theirs. So I think there's, this ongoing discussion of whether or not Bitcoin can actually decouple from, the NASDAQ and being a risk on asset. I don't think we're there yet. And I don't think we've seen enough proof that it is really a non-correlated asset. But there has been moments in time that are, I think, making that argument stronger. And from a, portfolio construction perspective, we have clients that own Bitcoin, but I would say they're more satellite positions where, they understand the risk where there's not really a way to value it today. The fundamentals are still a little unclear. It's not like a stock where you have earnings and you have a multiple and there's fundamentals to actually come up with a valuation. It's more of a supply and demand dynamic. Wouldn't necessarily say it's, a pure, storage of value like gold is, but it does have, some of those aspects. And if we do see a further, decoupling from this risk on trade, it might make that, argument stronger.
Well, look, the reality is gold has very little intrinsic value, but there is a cost to pulling it out. And it's been around for 2,000 years, 3,000 years as a storage of value. Like for thousands of years, longer than we've had money, gold has been the thing that people have used as a safe haven, as a thing to
Mm-hmm.
have. Bitcoin, obviously, not as tangible, and it certainly doesn't have the history. Who knows? As we know, Coinbase is now going to be added to the S&P 500, and obviously, the more legitimized it becomes, the more of a real asset it becomes. Scott, I know a lot of the folks here very big on gold and silver and Bitcoin as well. And do you see it the same way? It's sort of for now, a tangential asset, not a core asset for people?
Yeah, look, I mean, Bitcoin certainly has come a long way the last couple of years, right? I mean, just the idea of Coinbase being an S&P 500 stock, you've got ETFs out there now, with large firms, which add more, sort of stability to it as an asset class, certainly more credibility. Yeah, look, we've got clients that are very, very bullish on Bitcoin. I can't argue. It's very, very hard. It's just an interesting asset class, right? I own a little bit myself. I think if you've got a long-term time horizon and you can stomach the volatility, yeah, own a little Bitcoin. You can buy an ETF. Um, it's easy to get in and out of. We're not recommending people trade it, but I think 5 years from now it'll probably be worth more than it is now. It's very hard, as Alexis said, though, to really try to handicap that because what's your metric?
It's kind of
But
binary outcome, right? Like if it becomes a legitimate currency that everyone uses, then guess what? It'll be worth a lot more. And if it
yeah,
kind of is doing the same thing, it could be worth half as much because
that's right.
it's just whatever
But
anyone's willing to pay for it.
I think it's safer buy now than it was 2 years ago, though,
Yeah,
personally.
for sure. Well, let's go to our big topic for the day. And obviously, it's all about the China tariffs. We have a 90-day hold, and the markets have been very excited about that. And so let's just talk. I've got a question here from Adrian in Los Angeles, and he's trying to understand what the deal with China, although there is no deal today, there's an agreement to try to get a deal in 90 days, and what it
Mm-hmm.
means for the market over the next 3 months. So, I guess for the rest of the summer here. And thinking about how he should try to invest. Obviously, he should have already been invested, but if you're sitting today and you're invested or not invested, how should you think about the next 90 days? We obviously have already had not all, but a big part of the decline recovered, about two-thirds of it. So this is usually when it starts to run a little bit out of gas. But how do you think about the next 90 days? Alexis, why don't you take that one?
Yeah, absolutely. So in the short term, we're all experiencing it, the exuberance, as I mentioned earlier, with some positive news, and it seems like we're heading in the right direction with China. But to your point, we haven't made a deal yet. So I think what happens in the next 90 days will really determine the sustainability of what we're seeing, more recently in the markets and the massive reversal that we've seen. We're going to need to see a more substantial and real, deal and agreement to be made for this, I think, to be more durable and more progress made, in general. But I think we are somewhat wary that everything is over and that we're out of the clear, or in the clear, I should say, and think that there probably is some more volatility and downside to come. As fast as we can move up, we can move down just as quickly with, a press release or a headline. And we would be using those opportunities, as Scott mentioned before, to rebalance, but not necessarily wanting to chase at these levels.
And Scott, we've been in the deal business long enough and 3, 4 decades doing this investing to know the perfect deal is one where everyone is sullen but not mutinous. People are getting what they want, but not all that they want. That's usually when you get to the right place. But as we know, we have a president and a premier of China who do not want to look bad in any transaction that occurs. And that does feel like it's fraught for some standing away, getting away from the table, and some mudslinging. I hope it doesn't happen, but how do you think this is going to play out, and what does it mean for investors and the markets? Do we hold steady with volatility and where we are now 90 days from now, or how do you think this plays out? Obviously, for now, the tariffs aren't going to go to I don't even know where they've settled out, actually, but where do you think we are over the course of the next 3 months?
Look, I mean, 3 months is not a time frame to be an investor, right? You could speculate. I mean, I think there are people out there, if you think that, like some of my clients, that Trump is playing 3D chess and everybody else is playing checkers, then, maybe you speculate. We wouldn't recommend that. If you have people out there who think that he's, way over his skis and, his plan doesn't make any sense, then you'd be very negative on the markets. The truth is probably somewhere in the middle, right? Tariffs are not generally a good thing. So we're not really sure where this thing's going to wind up. Look, if I've got a 5-year time horizon, I want to be in equities. We like U.S. equities. We want to be diversified. We think that value stocks are probably a better value, non-U.S. equities, as we talked before. But if someone's got, a need for money in the next 90 days, 6 months, 12 months, even 24 months, I wouldn't have that money in the market anyway. As we've kind of gotten back to level here, if I've got extra cash that I think is long-term money I want to put in my, it to work, and I want to get a real good deal there, I'd probably wait and see, maybe dollar cost average here, pick some spots, because I do think there's going to be an opportunity to get into this market at a lower level. But this deal's not over yet. I don't think anybody even knows what's on the table, and the fact that we've got another 70 days or whatever we have to work through it.
And next question is from Mark in Long Island. He's 55. And he's still in his prime earning years, but is unsure how to manage his portfolio, with some saying the Dow could go to 6,600 by year end, while some are warning a recession. Scott, you kind of answered this question. He's invested, he's balanced. Should he be doing anything other than not worrying about the next 90 days? Is there anything you would recommend? And one of the things, obviously, make sure that your target allocation is right. And obviously, if the markets are going to go down, that you don't have so much risk that you're afraid and lighten up and sell at the worst possible time. But any tips for Mark? Does it matter where the market goes in your mind?
You want the market, if Mark's got a 5 or 8 year time horizon, he ought to be rooting for the market to go down. If he's still earning money and saving money, and he's going to want to use that money in 5 or 8 or 10 years. The best thing that could happen for Mark is for there to be another hiccup here and him to have some cash that he can invest and take advantage of those levels. What you don't want to do is you don't want to get out of the market because you're scared. You want to invest based on time horizon. You want to always make sure you've got enough liquidity to cover your expenses and to manage your business and do whatever else you've got going on in your life. But again, we're going to have a lot of other topics that we're going to talk about, Joe, in the next 2, 3, 5 years as we do these podcasts.
And I think very important here, if Mark is 55 and let's say he's working till 65, he's got 10 years where there's going to be many more dramas that come in. And he should
100%.
view every one of those dramas as an opportunity to increase his investments by
That's
taking
right.
his savings. Hopefully, his kids are in college, or if he has kids, and he's got the ability to net save and can invest in the markets. It's a very different thing once you've retired, right? Like you have to be much more thoughtful about market volatility once you're using your savings to live on.
Yeah, but I think once you get to that point, again, what you do is you create a portfolio where that's where you use laddered bonds, and that's where you have income coming from, dividends, where you know where the income that you need is coming from. Your equity portfolio is that part of your portfolio, maybe that half of your portfolio that you're not going to need for 5 or 10 years. So again, in our practice for our retired clients, we know where our income is coming from literally for the next 5 to 7 years. So again, we're never worried about where's the market going to be at the end of the year. We're not going to need, we hope that those equities could potentially be lower at the end of the year. I don't need that money for 7 years. That'll give me an opportunity to take a little bit of my fixed income, roll it over into cheaper equities. So as time goes by and the markets recover and advance, we'll have more, we'll have more money there for our clients' second half of their retirement, if you will. So people should be paying much more attention to their time frame and their liquidity need than they should be tariff deals, you know, whatever else is going on. Like Joe said, we're going to have lots of drama to talk about here in the next 5 to 10 years between now and the time that Mark retires. So I wouldn't, spend too much time and energy focused on that. Honestly, work a plan, have a
And
plan, work your plan.
And I think this ties into the last question. I know you work with a lot of CEOs and entrepreneurs. Tim in West Palm Beach, Florida, is a small business owner with goods manufactured in China. He's stuck because he's running out of inventory, but worried about ordering more and then having them come and have the tariffs hit right when he receives everything. And so he wants to know how he should think about his business and how much cash he should set aside. I'll take this one just to start off. First of all, as an entrepreneur my whole life, I'd just suggest a couple things. Other than my spell at Goldman, which was very different than running your own business, but I'd say a couple things. Number one, you cannot use investment money as something to run your business. You have to use that as cash. And if you are an entrepreneur and your business is not large enough to be self sustaining in all environments, and you expect your portfolio to support you, you have to think about your business as another person with needs. And if those needs are really large in a tough time, I would strongly recommend that you have a very significant cash reserve for that eventuality, because the worst thing that can happen is you have investments in the market, something bad happens with tariffs, at the same time that your portfolio is going down, your business now needs the cash. So you need to really think about diversification if you're a business operator in a different way than somebody that's just simply working and retiring, because your risks, especially in this case, because you know the markets, if things happen bad for your business because of the tariffs with China, they're almost certainly going to be reflected in the stock market. So any additional thoughts on that, Scott?
No, I think that's exactly the way you should think about it.
So make sure you think about your business as a standalone and say, how bad could it get? How much do I need to have? And either have a credit line that gives you that ability to get to the other side, or have cash available, because there is nothing worse than having a business that cannot make it through a lull or a temporary spike down. And that is where most of the pain will be felt. And we've seen it in the Russell 2000. The smallest stocks have really not done, they seem to find their footing right after the president was elected. And any thoughts, Alexis, just to wrap up here on the week on the Russell 2000 and smaller companies? Because I've been quite disappointed what we've seen in them, and on the way down and on the way back up. So I think they probably have the most risk, just like Tim in West Palm Beach here. Any thoughts on small caps?
Yeah, I think that's a great question and point. And as we were talking through the question and the response, I think that whole sort of conversation is what is really important, and that I think the market might be broadly ignoring, where there are small businesses, and we're seeing it in the Russell 2000, Russell 3000, that these businesses are struggling. And even though there's some positive news around China trade developments and this pause, and ultimately maybe things wind up better than feared, but there's still disruption happening every single day, and businesses are not able to make decisions, and that is going to find its way to the surface, where there will ultimately probably be a slowdown and there will be impacts. And that's why, Q2 and Q3 earnings, I think, will tell us a lot more of the story of what's been really going on under the surface this year.
That's super helpful. And as we just saw, Walmart is expecting as much as double-digit price increases regardless in the coming months. So we'll see how that impacts the economy in general. So thank you very much, guys. Let's talk a little bit about what's coming up next week. I, for one, will be watching the NBA playoffs, although the Lakers lost, unfortunately. I just came in from New York today. I'm super excited to see what happens with the Knicks and Celtics, and really great basketball. But that's not what we're here to talk about. We're here to look at what's happening next week. I think obviously the tariffs, news on the tariffs matter. What do you expect? And any big news you expect for next week? I think we're through most of the earnings, Alexis. Any big earnings for next week?
Yeah, no, I mean, we're, so far treading along through Q1 earnings, and there's some other companies to report, but the Mag 7 are pretty much done. So I think all eyes will be on tariffs, really, and if there's any other developments, mainly with, the China negotiation. So yeah. I think that is top of mind.
And we should remember, again, a lot of the words said by the administration could be negotiating tactics, but they could be real. So I would not put too much stock in it. It does seem like people have now accounted for a certain amount of words that might not mean a lot. Scott, what are you looking for this coming week?
I don't disagree at all with what you said. I think a lot of the earnings stuff is out. I think there's been a lot of overreaction potentially, particularly in the pharma space, with some of the remarks the president's made about pharmacy costs, drug costs. I think what we're finding as people are digging into that more, that a lot of what they're talking about doing can't be done. It can't be done from a legal perspective, right? It can't be done from a legislative perspective. So I think as we move along here, what we're going to find is there's not going to be quite as much abrupt change as people think. There's been a pretty negative reaction here, particularly in the healthcare space. I was speaking to our healthcare manager earlier today. Thinks it's a great opportunity, quite frankly. There are some companies out there that are going to have some challenges, but there are a lot of really good companies out there that are going to benefit, and they're all kind of getting beat down here. The United Healthcare story, I think, has drugged the sector down a bit as well. So I think there's really good potential there. I think you're going to have to be very selective in that space. But again, I think we tend to react to the headlines, and then after time goes by, what we find is that the moves that they're talking about are never quite as significant as people were afraid.
And you look at the aging of the population, the fact that we're not going to stop using drugs. It's an interesting area to stare at. And so thank you very much, folks. If you are interested in having your portfolio reviewed by amazing people like Alex or Scott or some of the other folks on the team, please come to wealthion.com/free. You're welcome to share your information. We'll, of course, send it back to you confidentially. And if you have any questions, thoughts, topics you'd like us to cover, please let us know. And I'm excited to let you know that Terry will be here next week and do a much better job than me in helping to co-host this. And we'll see you all soon. Thank you very much, Alexis, Scott. Really appreciate you. And thank you for watching. Have a great week.
Thanks, Joe. Appreciate it.
Thanks.